culture matters. But you know what matters more? The system operating right under your nose while you're busy being distracted. Imagine two metals on a table, gold and silver. Right now, the most powerful institutions in human history, the Federal Reserve, the People's Bank of China, the ECB, are hoarding one of them like their survival depends on it. They are stacking gold at a pace we haven't seen in 50 years. But silver? They treat it like industrial scrap. The mainstream media tells you this is just market dynamics. They say silver is just another commodity. That's not the full story. What you're witnessing isn't random. It's a silent positioning strategy. The system teaches the wealthy how to preserve their power, and it teaches you to chase stock tickers while holding paper currency that quietly loses purchasing power every year. The stage for 2026 is already set. A massive wealth transfer is being engineered. And if you don't understand why central banks are aggressively buying the shield while leaving the sword on the floor, you risk standing on the wrong side of the shift. Today, we're exposing a mechanical, rule-based phenomenon the financial media avoids. We're breaking down the great gold hoard and the silver disconnect. For 5,000 years, gold and silver moved together. When gold ran, silver usually ran faster. Both were money. So why, in the 2020s, have the gatekeepers of the global economy separated them? Why are they monetizing gold while effectively dismissing silver from their vaults? Is it incompetence? Or is it calculated positioning? By the end of this video, you'll understand the disconnect in the gold-silver ratio, the supply cliff almost nobody is discussing, and why silver isn't just positioned to rise. It's structurally primed for volatility. Let's step away from emotion. Let's look at the math. Watch behavior, not rhetoric. The job of a central bank is stability. They don't speculate. They don't chase hype. Yet in 2022 and 2023, central banks purchased more gold than at any point since the collapse of Bretton Woods. China, Turkey, Poland, Singapore, even Western nations quietly repatriating reserves. Why? Because gold is no one else's liability. When bond markets shake, gold holds. When inflation erodes savings, gold protects. When geopolitical risk rises, gold is universally accepted. They are buying lifeboats. But here's the contradiction. If they are preparing for monetary instability, why aren't they buying silver? Silver has served as money longer than the US dollar has existed. It's finite. It's tangible. The difference is structural. To a central banker, gold qualifies as Tier 1 capital. It reinforces balance sheets. Silver does not. Silver is categorized as industrial, volatile, secondary. And that classification, that dismissal, is precisely where the opportunity may exist. Think of it this way. Gold is a cruise ship. Massive, stable, slow, built for endurance. Silver is a speedboat. Fast, violent, unpredictable. Central banks cannot hold assets that swing 10% in a week. They need stability. But because they ignore silver, because they treat it like copper or zinc, they leave it exposed to supply pressure. And here's the catch. Silver is no longer just money. You cannot build advanced weapon systems without it. You cannot build solar panels without it. You cannot build electric vehicles without it. Industrial demand consumes silver continuously. When the economy slows, factories pause and silver dips. Gold doesn't care about factories. Gold runs on fear. So central banks accumulate the fear asset and leave the industrial asset to the open market. But the paper market complicates the picture. Silver trades heavily through futures contracts and derivatives. Paper supply often exceeds physical supply by multiples. You can suppress a beach ball underwater for a long time, but not forever. Now combine demand with geology. Over 70% of global silver production is a byproduct. It comes from mining lead, zinc, and copper. Silver is not typically the primary target. That creates a structural constraint. If silver jumps to $100 tomorrow, miners can't instantly increase supply. They're mining for copper. They can't just flip a switch. Supply is inelastic. Meanwhile, global demand has exceeded production for multiple consecutive years. Above-ground inventories have been declining. If physical demand spikes, if industrial users demand delivery instead of rolling contracts, the stress moves from screens to vaults. That's when price discovery shifts from theory to urgency. This isn't speculation. It's arithmetic. Now let's talk about the gold-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, across long stretches of history, it hovered near 15 to 1. In the modern era, the average is closer to 40 to 1. Recently, it has pushed toward 80 to 1. That's extreme. If gold remains stable and the ratio reverts toward 40, silver must rise significantly. If gold rises and the ratio compresses, silver's movement becomes amplified. The silver market is dramatically smaller than gold. If even a fraction of capital flows shift toward it during a momentum phase, volatility accelerates. That's not hype. That's market structure. Central banks are playing defense. Speculators chase headlines. Strategic positioning looks at asymmetry. Let's simplify. Central banks hoard gold because it stabilizes their system. Silver sits outside that institutional protection. One asset reinforces power. The other responds violently to imbalance. The deficit is real. The ratio is stretched. The supply is constrained. Whether or not a squeeze materializes depends on flows and timing, but the structural tension exists. Central banks have chosen their shield. The question is whether you understand the mechanics behind the sword. If you want analysis rooted in structure instead of noise, subscribe to the Economic Brief. We don't chase narratives. We study mechanics.